Good evening, everyone, and very warm welcome to Q4 FY18 earnings of VIVIMEDLAB Limited. Along with me on this call today, I have Mr. Saurabh, Executive Director, Strategy and Business Development, and Mr. Sunil Arab, Vice President, Corporate Strategy. The results and news presentation is going to be uploaded on the stock exchange and company website, and you'll have a chance to look at it. I will start the discussion on the performance of this quarter FY18. Our revenue from operations stood at rupees 1185 crores, which is lower than FY17 revenues, mainly due to divestment of specialty chemical business to Clariant and FDF business to Clarcell. EBITDA stood at 211 crores with margin of 17.8%, which is in line with our strategy to move towards high margin business in both our business segments. Sharp increase in raw material price of one of the key raw materials for the API business has led to decline in profitability during the quarter for the API business. Our formulation business has witnessed a good growth and the momentum has sustained post-GST implementation. Company's strong track record of regulatory compliance has provided a competitive edge. It has been differentiated for both CMO and generic business and helped drive the sales and order book. Our net profit stood at 75.4 crores for FY18. The interest cost was reduced sequentially from rupees 24.2 crores in Q1, 21.4 crores in Q2, 17.2 crores in Q3 to rupees 16.4 crores in Q4 FY18. The reduction in finance cost has been a result of repayment of some high-cost loans, and total debt is down to rupees 770 crores at the end of March 18 from rupees 1,006 crores in March 17. In formulations, our 50/50 joint venture with Strides Sassoon has been completed, and this will help us to focus on our manufacturing strength while leveraging the marketing potential for Strides Sassoon to expand the US markets. Most importantly, this will help us in reducing our losses on account of low capacity utilization. We are quite optimistic on this JV and hope to start contributing to revenue from FY19 onwards. And predictions for FY19 are very optimistic and very interesting. During the year, we have successfully issued 8 products in antiviral, pain management, and suppressants. Post-certification with Ukraine FDA for Unit 1, located in Hyderabad also, we have signed a distribution agreement with the company Alter-Ego, based out of Kyiv, Ukraine, for distribution across in Ukraine, Russia, and other CIS regions. With the help of this agreement, we expect revenues upwards of 10 million euros in FY19. We have recently acquired Sonias, a leading Central European custom and contract developer and manufacturers of fine chemicals to pharma and other industries based in Budapest, Hungary, to broaden Vivimede's market offering in the CDMO space by enhancing its ability to now undertake preclinical phase 1, 2, and 3 and NC project development. The company has a high level of competency in NC development, as well as 2 technologies such as metal catalysis and heterocyclic chemistry. The value proposition that the acquisition provides is it broadens Vivimede's market offering in the CDMO space by enhancing its ability to now undertake preclinical phase 1, 2, and 3 NC project development. The above projects can also feed into Vivimede's existing CGMP inspector and approved manufacturing facilities in Spain and Mexico, creating a high-value project pipeline. Sonias brings both CGMP pilot plants and over 180 KL of key starting material CGMP capacity to Vivimed portfolio. Acquisition of Sonias will allow it to expand faster into CDMO sector, which accounts for 40% of Vivimed sales. The full year normalized numbers for FY17 after excluding the gains from sales moved to Clariant and Clarcell are revenue rupees 258 crores, EBITDA is rupees 246 crores, net profit is 85.2 crores on a full year basis. With this, I now hand over the call to Saurabh. Thank you.
Thank you, Mr. Santosh, and good afternoon to everyone who's on the call. Mr. Santosh has already discussed in brief about the financial performance for the quarter, so I will just like to comment on 3 topics, I think, which are pertinent to the financial performance during the quarter. One is, of course, the lower gross margins and profitability which we have seen in the pharmaceutical business, largely the API segment coming out of impact of raw material prices. And I think this is a trend which we have been noticing across the last couple of quarters, where we have seen certain spikes out of feedstock prices, especially coming out of China. And this has impacted us, to some extent in the last 2 quarters. What we have begun to do now is to obviously qualify alternate source of suppliers, and also gone back to customers and asking for some sort of a pricing uptick, which we have now begun to see. So our view is that, especially on the CDMO business, where they've had to take a certain hit in terms of increased raw material pricing, we'll be able to see benefits of recompense coming through from the Q1 of the new financial year, which has just started. The second update related to the pharmaceutical business is, of course, on the growth prospects. And here it is pertinent to mention organic and inorganic initiatives which have commenced. On the organic growth outlook, clearly being present in Europe and North America in terms of a manufacturing footprint, and more importantly, having a strong compliance track record with the US FDA, EDQM, etc., has helped us. And we believe that the volume growth which we have been seeing in the last 2 to 3 years out of UKIFA, and that is something which is likely to sustain for our current molecules. And to complement the volume growth of the existing portfolio, we have a lineup of new launches which we expect to start contributing to sales from this financial year, and we will see the real significant impact in FY20. We've had nearly 5 approvals come through to us on the generic portfolio of UKIFA in the last 6 months, and all these will start to go commercial within the next 12 months, and we expect that these are likely to add to 5 to 6% of extra sales compared to what the UKIFA-based business is now. The other important point on the inorganic side, which is pertinent to note, and Mr. Santosh has already made a mention of it, is the small acquisition, tactical acquisition, which we have done of Sonia's, which is a leading Central European player, which is focused on the CDMO sector and serves many large customers in innovative pharma as well as fine chemicals with pre-clinical phase 1 and phase 2. We believe that this is a synergistic fit for UKIFA, as it completes the value offering which UKIFA has to provide to the customer base in terms of the development and the manufacturing life cycle. And we believe that the projects which are right now being run in Sonia's, there is a synergy for UKIFA in migrating them to the large-scale GMP. While we're in the process of integration, and we will give more updates in the coming quarters as to the progress of this acquisition. The third aspect which I would just like to mention on the specialty chemical side before I hand the call over is that we've seen reasonable growth on the sales side, and also in the key accounts which have come through to us. More importantly, we're also pretty optimistic about the potential scale-up of a relationship which we expect with the top-tier Japanese name to start commencing in the current financial year. So with this, we believe that the 3 segments which we're focused on, which is the API, specialty chemicals, and the India formulations, are well positioned going into the new financial year. And we believe that we have taken steps which have taken them to a greater level of value addition compared to where they were 12 months ago. With this, I would like to throw the floor open for Q&A. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets when asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Qtr4 from Qtr4. Please go ahead.
Hello, sir. Yeah. Hello.
Yeah.
So first question was that in the consolidated accounts that you have given for this quarter, there is mention of an equity of 325 crores. So what is that pertaining to? Secondly, it is about the chemicals, specialty chemical business, where we have seen a huge swings in profitability on the negative side. So what is the reason for that? And what would be the next debt of the company as of March 2018?
I'll just take this question. The first one is account of the equity that was infused by Vivimed. So Vivimed had invested about $50 million in our subsidiary UPIFA as a holding company at VIVIMEDLAB Muscatine. So that's inclusion of about $50 million. And the second one is that your specialty chemical business this year has seen, of course, there's no. Last year there was a revenues on account of Clariant, on account of certain job works we have done for Clariant, and all of them. But if you really see like-to-like comparison in specialty chemical, what we now retain is the hair dye, photochromic, and antimicrobial. And if you really compare like-to-like comparison as per last year, then the India specialty chemical business last year was just about 45 crores in this segment, which has grown to 65 crores. And in UK, it was about 11.3 GBP, which means about 97 crores last year. It has grown to 14 GBP, which is about 129 crores this year. So obviously the EBITDA levels also were pretty healthy, over 25% in the second segment. So, of course, the reflection that probably comes to the numbers is that you see the revenues of last year with Clariant and other things that we have done job work. Now, if you really do a apple-to-apple comparison on the segment that we retain, there has been organic growth.
Okay. Yeah. Last figure was on net debt.
Yeah, net debt, if you see, last year was about 1,006 crores, which is now come down to 770 crores. So there's a reduction in the term debt as well as in the working capital.
Right. And there had been some warrants issued earlier which had been cancelled and then reissued. So what is the status on that?
Yeah, the warrants earlier, which were, given, I think we had a challenge in getting some approval from NSE, BSE, and then it became a time bar, so we cancelled it. And then we proposed in the board meeting last in March for the fresh warrants, and which board has approved it, and we have now gone again to BSE and NSE to get an approval. So once we get an approval, and we'll go on and subscribe for it.
So these warrants will be only to the promoters, or these are other investors also?
Yeah, it's 50% to promoters, 50% to non-promoters. So, and warrants were priced at about 104 rupees as at the time of approval.
Right. So that would be. So why would the promoters or any investor not buy it from market and buy it at 104 rupees at a premium to the market?
Absolutely.
So I think that would be the reason why it would not have got subscribed even the last time, right?
No, it is not the case. Last time it was a reverse case. Last time the price was lower and the market price was higher. But BSE NSE approval did not come because out of the non-promoter, one of the non-promoter group had actually, as per the rules, he should not buy or sell stock in 6 months' time. So one of them had bought or sold stock within 6 months. So NSE did not go ahead and approve the whole thing. So we had to cancel the whole proposal. And this time it is a reverse. This time, when we did a board meeting, at that time the average price worked out to be 104 rupees. And thereafter the price fell down to whatever levels it is today.
Right. But the promoters and the investors are the same and they are committed to buy at 104 rupees per share.
Yeah, they are committed to buy. And I think once we get an approval, I think we'll probably see the 25% of the money coming in. And then within 18 months, they'll put the balance money.
So that would again reduce your debt by what amount?
Within 18 months, there'll be infusion of about 100 crores. So obviously, to that extent, debt will come down at the India level. So just added to your question, I think the debt is roughly about 370 crores at India level and about close to around 400 crores at the overseas level. Post our acquisition of Sonia's, where we have added little bit of debt in that. So this is a figure which is post acquisition. So the 370, obviously, if this 100 crores comes in, will come down by another 100 crores.
Right. Post the dilution of these warrants, the promoter stake, which is 36%, will be going up to what, 50%, or will be going up to 41%?
Yeah, roughly around 44% or something like that.
Okay.
46%, roughly.
46%. Okay, great. Thank you. I'm done. Thanks.
Thank you. The next question is from the line of Shikha Mehta from Qtr4 Capital. Please go ahead.
Hello.
Yeah, go ahead. Yeah.
Good evening, sir. Also, actually, I wanted some guidance on the other expenditure, which has seen significant increase in this quarter. So is that one-off or what is that due to?
Shikha, if you have seen, if you really see, dissect the business today, I think substantial business comes from the European entities. And as we have seen, there has been a steep rise in the euro-rupee conversion. It was roughly around 63-64 last year to close to about 80 now. So when we translate into INR, you would have seen the effect of that, as increased expenses. But it's a matter of, currency fluctuation vis-à-vis Indian rupee. And again, as we are speaking now, that 1.2526 to dollar has come down to 1.16. So probably you will see that impact whenever it happens. But the expenses per se have not gone in linear currency. If we talk about euro to euro or dollar to dollar or rupee to rupee, the expenses have not gone.
So, but on a quarter-on-quarter basis also, there has been a significant increase, if you see.
Right, Shikha, because that's again, if you see quarter-on-quarter, if you really see the euro, the way it is moving, at the beginning of the quarter, euro was just about 72 rupees, and then when we averaged out, end of the year, it almost became 78 rupees.
Right.
Yeah.
All right. And so if you say our intangible assets have also gone up, so what is that due to?
Intangibles.
Intangibles and capital work in progress.
Yeah. See, if we have seen the private equity, we bought them out last year. So obviously, whatever, like a difference between this thing has gone up in the intangibles. So you'll see the difference because of that higher payout to private equity. They had invested about $12.5 million in FY12, and they were paid about $29.2 million when they exited last year.
Right. And the capital WIP that has increased?
Come down.
Yeah.
Yeah. Shikha, this is Ramesh. Actually, 76 has come to 65. We have capitalized actually. So that's right.
Right. And so I was just looking at a segmental breakup. On a quarter-on-quarter basis, our margins in specialty chemicals has been reducing, and from last quarter to this quarter, it has come down significantly from around 37% to around 18%. So again, is that a one-off, or what margins do we normally look at an EBIT level?
It's a one-off expenditure that we have given inspection.
Sorry, sir, I can't hear you clearly.
That is basically with regard to the FCTR. That is basically because FCTR with regard to the Ind AS correction.
Right. So I just have a few more questions. On our balance sheet, we have given a certain amount of our loans have increased. The loans that we've given, loans and advances, so by around 22 odd crore. So who have we given that to?
Are you looking at standalone?
Consolidated.
Consolidated. Which line item is you are looking at other?
Loans and loans. Current assets.
62.84, right?
Right.
Yeah, basically the input of the GST impact will be there, and we have given some capital advances also.
Sorry, sir, I cannot hear you clearly.
Yeah, capital advances also have been paid.
Also, your voice is not coming clearly.
It actually includes, one is the advances which have been paid, which are capital nature, and statutory receivables like GST and all.
And moreover, the rate.
Right.
These two are the major elements. Some forex is also involved.
Right, sir. And sir, could you give me a gross debt levels?
The debt levels are right now working capital plus long term is about 770 right now.
So what are the other financial liabilities then?
Other financial liabilities, I think that includes everything, including the FCCB. It includes FCCB of 48 crores, which has been now extended maturity to September 2019. So that is still not converted into equity. It still has FCCB. So that also includes the 48 crores of notional liability.
Right. And so our working capital, if you could give some guidance on, because I think it has increased a bit, the working capital cycle.
Working capital total it's come down compared to last year. Last year it was about 375. It's come down to 350. Total working capital loan. I think in terms of cycle, I don't think it will increase.
I was doing some base level calculations, and I think it's increased a bit from around 150 levels to around 200 odd days.
We'll get back to you on that, Mika.
All right, sir. And do you have any guidance on FY19 top line?
FY19, I think what you should expect is that I think whatever divestments and those incomes which were there, that's all gone. So obviously, what we are going to have is revenues from three clear verticals. One is your FDF business, which is predominantly India plus the JV business and the specialty chemicals, as well as the API business. API business, you will see the revenues from Sonia is also coming in. So our expectation is that from about 1,195 crores of top line that we have done the current year, it should at least grow over 20% this current year, FY19.
And do we have any capex or acquisition plans in FY19?
FY19, we need to, of course, consolidate our revenues from all segments, and there will be a capex in India in the formulation, which we guess it will be around 20-25 crores. And then back in API business, again, there were almost like a maintenance capex, about 30-35 crores. So about 50 to 60 crores capex will be incurred even the current year, FY19. That will go on. And we are not anticipating any further acquisitions or any other thing at this point of time. There is enough pipeline to be capitalized. As Saurabh explained you, Sonia's acquisition provides plenty of opportunity for us to scale up at the EPFA level, commercial at the EPFA level. So I think we'll be pretty busy in doing those things.
All right, sir. Thank you.
Thank you. The next question is from the line of Shruti Mehta, an individual investor. Please go ahead.
Hello. Good evening, sir. I have three questions. So what is the rationale behind the Sonia's acquisition, and what is the transaction value, and how do you plan to fund that acquisition?
Saurabh, you want to take it?
Yeah, I think as far as the rationale for the acquisition is concerned, we made a reference to it in the opening remarks, but I'm happy to repeat it. If you look at Qtr4 today, nearly 40% of our sales comes from the CDMO segment, where our customer base is big pharma companies and innovator companies where we do exclusive development and manufacturing work for them. Qtr4's footprint is basically from phase 2B onwards, phase 3 in commercial launch. Where we do not have a role as of today is we are not involved in the pre-clinical phase 1, phase 2. level of pipeline, which is because we don't have the development capability on an organic basis. So what Sonia's offers to us is that capability, which helps us to provide a complete value offering to our CDMO customer base. And, we believe that is a significant differentiator in this business. And if you look at the names which have scaled up their CDMO portfolios to a large extent, all of them offer a complete value offering. So we believe that this is a strong synergy which comes to Qtr4, is a complete positioning in the marketplace. And I think you mentioned about the size of the business. I think last year Sonia said built close to 12 million euros in terms of sales value. And they have a pretty reasonable pipeline from what we are seeing, and we believe that there will be at least a couple of projects which can migrate from their pipeline to the large-scale GMP platform which we have in Qtr4 across Spain and Mexico.
The current participant has moved out of the question queue. We'll take the next question from the line of Raghavendra P., an individual investor. Please go ahead.
When I see the balance sheet, it is convincing, but are there any rationale behind the value erosion of stakeholders' money in the last 4 months? Right from 110, the price has come down to 50, 59 or whatever it is, today's price. In spite of adding Vivimed Capital's news of $50 million infusion, in spite of acquiring the new company, can you just throw some light on winning the investors' confidence and whether the company is approaching any fund houses, doing the presentations in a big way to make sure that whatever we have lost, the gain, whatever the confidence which we have lost in the market, in the investor stake?
I think that's a good question. A little bit of, we also wonder because we did all the right things in terms of whatever we promised to the stakeholders in terms of optimizing on the debt. I think the debt has come down, and even for that matter, we have optimized the cost of debt. So the debt cost in last year was almost like 13% at India level, which has come down to now 10 to 11%. And there's some more, of course, actions which will probably happen by end of June in terms of reducing our high-cost debt sitting in a Mauritius entity, which will be replaced by a European bank. So we have actually whatever we promised, I guess we have done it. And at least now probably there was a little bit of confusion in terms divestment and few things. But again, we want to instill the confidence that today I think Vivimed is a focused company in terms of pharma growth. We have all the aspects of growth, whether it's API space. We have built up a very interesting pipeline. What you have not seen last 3-4 years, we have built up almost 5 to 6 APIs, DMS filings last year, and even the current year we're doing it. And the CDMO business 3-4 years back was less than 10%. Now it's almost gone to 40% in Spain, and with customers like Gilead, Pfizer, and GSK. And then now with this acquisition of Sonia, I think we will inherit a very interesting pipeline. So my guess is that it's appropriate time for the management to go back, maybe meet the investors personally and give them a flavor of what Vivimed is going to be in the next 2 to 3 years. As far as the management is concerned, our business strategy is concerned, our plan is concerned, we are very optimistic of what our things are done. And some of the areas like FDF business, US FDF, that was also having a little bit of challenges till last year, and that's ironed out. And then from a meager turnover of about 10 to 12 crores for the JV business FY18, we are optimistic to do more than 125 crores in the current year, and the order book is looking good for us. So obviously, I guess we need to communicate this very strongly to the investor community and understand from them what their concerns are, because I think as far as management is concerned, I guess we are just doing what we said. And then another important thing is that it doesn't need a testimony that Vivimed, which is a multi-million-dollar fund based out of USA. Endorsers are, like strategy in terms of API and CDMO business, and they have individually valued the API business, CDMO business, close to more than about 1,100-1,200 crores itself. So, and you also seen that the specialty chemical business, which we hired off to Clariant, it was valued around 13.5-14 times of EBITDA. So what today we have is a very strong API CDMO business, very niche and special chemical business, and FDF business, which was having issues, but today it's on the growth curve. So there's no reason for investor to lose any confidence in our business model. We'll display what we can.
Thank you so much.
Thank you. Before we take the next question, we'd like to remind the participants that you may press star and 1 to ask a question. The next question is from the line of Suresh Agarwal, an individual investor. Please go ahead.
Good evening, sir.
Good evening.
Actually, in compared to last quarter, our specialty chemical margin as well as growth has been eroded. Could you please explain it?
Yeah, can you come back again, please? The voice was not clear.
No. Actually, in comparison to the Q3 FY18, our specialty chemical volume as well as EBITDA as well as net profit has been eroded.
Yeah, I think this is from 70 to 7. Is that what you're saying?
No, specialty chemical.
Yeah.
Yes, those are the numbers. Yeah.
Yes, 17 to 7. That is very correct. Because that is FCCR impact as per Ind AS we have given in the spectrum division.
No, actually, it's not audible, sir. It's not audible.
It is FCCR impact given in the specialty chemicals as per Ind AS impact.
No. If the raw material which we are procuring, the cost is very high.
What?
Raw material for this specialty chemical, if the cost was very high.
Okay, can you come again, please? I could not.
No, raw material cost for specialty chemical.
Raw material cost, no, there is not much of impact on that. See, I gave the bifurcation. If you really dissect away what has gone, the specialty chemical business for the whole year, as I said, the India, of course, specialty chemical business is India as well as in UK. India business has gone from 45 to 65, and UK business has gone from 11.3 to 14 GBP. So there has been a growth in the specialty chemical. The only thing is that if you take away the impact of all the divestments and then do an apple-to-apple comparison, then you can do it. You can get that number.
One more thing, this API manufacturer and your competitor, actually they have shown that their profitability has been eroded because of the rising cost of the API procurement from China and all this.
Yeah.
Is there any effect in our pharmaceutical business because of the petroleum crude price hike?
Agreed. So that impact, you would see not in chemical, specialty chemical did not get impacted too much, but what got impacted is in our API business. Our API business, if you see, it is the gross margins, because our contracts were already there in the previous prices and the raw materials have gone up, we had almost an impact of close to 3.9 to 4 million euro at our EBITDA level in the API business. That is mainly because of the increase in the raw material cost for what we are importing from China. So we could not translate this, we did not put this new cost to the buyer because we had a sales contract. But now that the prices have been accepted and then we are trying to now change the prices up at various APIs for the various customers. We did have an impact.
But again in this quarter, the crude has risen actually, no?
Saurabh, you want to take that question? Maybe you explain better.
Again, in this quarter, which is going on actually, like April to June this quarter, again, the crude prices is pick up.
I understood your question, so let me just give a response. So this quarter also we will see, at least for the first 2 months of the quarter, we will see some impact because of raw material pricing, which is adverse trend. But going forward from the next quarter onwards, which is from the July, August, September quarter, we have been able to get in certain cases price hikes, in certain cases we have been able to renegotiate raw material prices, etc. So things will start to improve from then on.
Is there any thinking going on for the this split of this specialty chemical from the pharma business?
I think, it's a good idea, obviously, but, I think at management level, we are still thinking and seeing the rationale behind it and how it would benefit the listed entity and the stakeholders. So if that proves to be positive and it's going to be beneficial to the stakeholders, I think probably the board will also approve the idea.
Okay. Thank you. Thank you very much.
Thank you. The next question is from the line of Srihari C. from PCS Securities. Please go ahead.
Yeah, thanks for the opportunity. In your opening remarks, you mentioned that a part of the pharma business was affected due to high raw material cost. But if I look at the overall gross margin, it's actually gone up by close to 500 basis points sequentially. So can you please explain this to me?
Yeah, see, if you see the business, in certain areas, particularly CDMO space, I think we haven't lost any much of gross margin. Actually, the gross margins have improved there. In API space, where generic API space, we did lose margins over there because the contract prices were, high and we could not give that thing. But in the CDMO, which was about 40% of our business, there we could get the price hike and that did not deter much of it. And at India level also, the margins were better. However, the revenues were less, but the margins were better at India level. Compared to, because India, we didn't have much of impact on the import of raw materials and all, because they're all locally sourced materials. That did not impact too much about it. And our nasal spray business and all, where I think the cost of materials were immediately, as per agreements, we could immediately translate them to the customers.
Can you please give the breakup of the pharma division? Sales breakup?
Pharma division, if you see out of that 1,195 crores, about 985 crores revenue came from pharma.
Right. And the split within that and the various verticals that you have?
Yeah, if you see that, the API plus CDMO business was roughly around 810 crores in the current year. And the formulation business was a balance, around 175, 180 crores, about 275 crores of formulation business in India.
Okay. And one question to Saurabh. You mentioned about a few launches. Could you please throw some light on that?
Yeah, I think on the so we have in terms of growth levers for the next 12 months. So we have a couple of projects on the CDMO side, I think, which will start to scale up, and that is becoming a big part of the business. One is, of course, bromination chemistry-based advanced intermediate, which we're doing for a Japanese innovator. And then there is also a certain project which we're doing with another European innovator for dermatological indication. So those are the two, I think, scale-ups which we're expecting on CDMO, which is 40% of our sales. On the generic side, I mentioned that we're looking at, in the next 12 months, a few interesting launches. I think the first of which we expect to be is Solifenacin. I think that's something which will come through to us. Then we are also well positioned in Ranitidine. And then we have a couple of older molecules which we have refiled, which are with more competitive processes like Qtr4 and Fluoxetine, which we believe, I think, will help us get a good revenue and volume contribution in the next 12 months.
I'm sorry, I didn't catch the second name. Solifenacin, and which is the other one you mentioned?
Within the new pipeline, I mentioned Solifenacin, Ranitidine, and Cinacalcet. And then within the new launches, I think the relaunches, which are already generic products, I think, which I mentioned, one was Qtr4 and the other was Fluoxetine.
For this pipeline, do you think the pricing pressure will have an impact in any way?
think in that sense, we're a bit different because we are a European company. So most of the seedings which we are doing are predominantly also for the European market. We have presence in the US, and the US is a significant market for us. But at least for the projects at least which we are involved in so far, there has been no pricing pressure. But clearly the generic portfolio otherwise, which is in the US, customers do keep coming back and talk about the pricing environment which they're facing, and they expect a level of accommodation from us.
Okay. And Santosh sir, can you please tell us a little about the joint venture? How did it fare in FY18, and what is the outlook for FY19? If you could talk in financial terms, please.
Yeah. See, FY18, you have not seen much of a top line. I think by the time the joint venture started, it was about June ending. So prior to June quarter, the revenues were about 20 crores odd. But post-June quarter, we had some backlog of orders that we have completed. But we are more, last 9 months, we are doing some filings, getting approvals and all. So revenue was hardly anything, and which was just about maybe another 10 crores. So we just posted about 30 crore revenue from that particular factory before and after. What has happened in the last, of course, 3 months is that we got an approval of Brantadine, which I think we have already shared that. And then whatever products that we had, Generic pipeline, Losartan, Zolpidem, and Amlodipine, I think they all scaled up, and we found good distributors. And another good news was that the Wokhard azithromycin which we had, which had gone into hibernation because of the API issue, I think that business recommenced, and again, that's looking good in the current year. And we are also going to commercialize one of the products of Strides, which is for the Australian market. So I think we are going to see some revenues coming from that. So that's the reason why I think from a 30 crore revenue last year, we are optimistic that this joint venture will probably give you north of about 120 crores in the current year. And we have the order book right now, and the sales and manufacturing is going at that rate, particular that rate now.
So you mean this 30 crore, 120 crore is at the JV level, or is it your share?
It will be at the JV level, but we'll be consolidating the revenues at India level in a consolidation. We do that.
And how would the EBITDA margin, how will it look?
EBITDA margin, we should see about 20% EBITDA in this year. But of course, next year, we have some interesting products like albendazole, which we are just awaiting approval from US FDA. If that comes in maybe third quarter or fourth quarter, there will be a spike in revenues, which we have not accounted in our projections at this point of time. And we also right now engage in waiting for approvals for 2 more products which we filed for our customers, which we are expecting again somewhere around Q3, end of Q3 or something. So that revenues will also pop in. So I think we are confident that whatever revenues growth we see in the current year, the following year will probably also be a very interesting year for the joint venture business.
That's great. So, but in FY18, did you break even at the EBITDA level?
No, FY18 we were not break even at the EBITDA level.
Oh, okay. It's fine. Thank you.
You're welcome.
Thank you. The next question is a follow-up from the line of Shikha Mehta from Qtr4 Capital. Please go ahead.
Hello, sir. So how long have our current auditors been auditing?
Here we have in the 3 entities that we have, the specialty chemical business from UK, we have audited Grant Thornton as our auditors, and for the whole API and CDMO business, we have Deloitte as auditors. Both these businesses together constitute more than about 85% of our revenue. And in India, we had an auditor, Mr. Murli Mohan Rao, which has been changed today to a new auditor. So, but I think India's implementation all are just completed. So probably next year we should look at trying to have only one single auditor for all the entities across the globe. So we are trying to talk to like some auditors, maybe Deloitte and Grant Thornton, who can probably have one common auditor across all our, operating companies.
Right, sir. And also, could you give me a breakup of the raw material cost over India and outside India?
If you see our business today, out of the 1,200 crore business, I think about 900 crores, a little over 900 crores comes from overseas. So what we have in India today is a formulation business, FDF business, and a bit of specialty chemical business manufacturing in India. So obviously, raw material impact at India level is not much, but as we already explained to you, at the API and CDMO business, there has been substantial impact on raw material, and that margins have slimmed down last year, but I guess, will cope up in the coming quarters.
All right, sir. Thank you.
Thank you. The next question is from the line of Suresh Agarwal, an individual investor. Please go ahead.
So you have not submitted this time investor presentation?
Investor presentation will be uploaded today by end of the day.
Okay. Next one thing, sir. In December 2017, your total sales were around 300 crore and your net profit was around 21 crore. And in March 18, your total net sales is around at consolidated level to 85 crore and your net profit comes around 9 crore.
Yeah.
What is the reason, sir?
So it's basically what happened, whatever is the currency fluctuation and all, that impact will all come in the last quarter. And as per the reporting, India is reporting and all those things, so all that impact has hit us the last quarter. It is more of adjustment in the last quarter, you can say.
Okay. It means actually from 21 crores to 9 crores means around 12 crores regarding adjustment.
Yeah, it was an impact, probably whatever we missed, that's the impact that has taken up in the last quarter, and that's how we are shown.
It will follow through in this April to June quarter or FY19 also?
No, I think, let's say, for example, you have seen a positive impact of euro versus dollar already hitting us. So obviously, you'll see some positive sides of it in the coming quarter. So, but that's not normalized. What you see that, from 21 to 9 is not normalized. It's adjusted. So what you are going to see is normalized is probably beyond what you have seen in the last quarter.
So what you are thinking that in FY19, what will be the profit margin should be, net profit margin NP of our turnover?
Yeah, I just gave an indication that, the revenue growth for FY19 would be about 20% in terms of, turnovers and all. Obviously, margins, there will be little pressure in the first quarter, but as Saurabh already explained, I think we have also gone to the customers and taken a price hike. So probably by Q2, Q3, Q4, we'll normalize the margins at the API level. And as you also have seen that, debt has come down compared to last year. Last year, we had a interest cost of almost 85 crores on a consolidated basis. And our projections for the current year are going to be something around 55 crores, almost a reduction of about 30 crores in interest cost. And 30 crores in reduction in interest cost and also the organic growth and the margins from that, I'm sure that, the profit margin should see a substantial jump in the current year.
It should be around 10% in FY19 of the turnover?
Or PAT margin?
Yeah.
PAT margins, I think it should be around 8 to 9%, I guess. I don't have a correct number.
Okay, thank you. One thing more, sir. Like whatever disbursement you have done, you have already done whatever you have acquired, like organically or inorganically, that has been done. Now it's time to consolidate and reward the investors like us who are invested in your company from last 5 to 6 years, but not getting benefited any time.
I fully agree with you. I think whatever beneficial to the shareholders including promoters like us. I think all that we have done. And now, as you very correctly said, we have invested rightly in terms of product pipeline. We have spent enough money on R&D, as you would see now, as I've just tried to explain at the FDF level as well as the API segment. So we have to see the output or results of all that has been done in the last 3-4 years. So I'm sure this will be the beginning of the year. FY19, you will see that substantial jump. And then going forward, we are working with some innovator companies where they're at advanced stage in phase 2, phase 3 and all. So I'm sure, one or two of those things coming in, and then our own efforts here should see a substantial shareholder value increasing.
One thing more, sir, your market cap is around 511 crore, like on debt. What do you think your total business minus debt? What should be your net worth actually?
I was just trying to probably give you that thing for a while ago. I was saying that our API business was valued by Vivimed, which is like Asia's largest healthcare fund. They valued it as around about close to 1,200 crores. And our divested chemical business, which was half of what we have retained today, that was valued around 380-400 crores. So even if I don't value my formulation business at this point of time, A plus B valuation should be much more, right? And then my debt today is just about 770 crores. So in my opinion, the 511 crores is a wrong depiction of the value of this company.
What do you think your value of this one, special chemical business, then after the businessman?
Come back again.
What you consider the value of your this specialty chemical business?
I think it should be at least 300-350 crores. Don't you think so?
Okay. Thank you, sir. Thank you.
Thank you. The next question is from the line of Rajnikant K from Precision Technicals. Please go ahead. Rajnikant K, your line is unmuted. Please go ahead. As there's no response from the current participant.
Hello?
Yes,
what is the status of pledge shares, sir?
See, since I was last time also had made a mention, these shares are pledged to the banks. So as long as the term loans still remain, the pledge will not come out. If you have seen, compared to last year, from 184 crores term loan, it has come down to 102 crores at India level. So we hope to bring that down, probably because of all the banking issues and all. We intend to either, repay the whole term loan or maybe replace with somebody and get the pledge out.
Okay.
So we have been trying to do that last 1 or 2 quarters. I've been mentioning about it. But I guess, now it's much easier because the debt also has come down substantially. So we should be able to do that before September. So if you are able to replace or we repay the whatever 100 crores of term loan left in at India level, I'm sure, our whole pledge will come out of the banks.
Okay. And any update on the Visakhapatnam land, sir?
See, we have been trying. We have got some term sheets from 2 possible buyers. But maybe because of the situation existing in AP, we have term sheets, we have negotiated, but the deal is still not concluded. So that's still on top of our agenda, which can probably bring in another 40-50 crores of debt reduction at our entity level.
Okay. Thank you, sir.
Thank you. Ladies and gentlemen, that was the last question. I would now like to hand the conference over to Mr. Santosh Varalwal for closing comments. Over to you.
Thank you, gentlemen. Thank you for your patience. You've been hearing us. As I said, whatever, divestments and, few things which we have to do, we have done it. And today, Vivimed is in a very strong growth curve. The API business, so now coupled with CDMO and addition of new entity, Sonia's, should see a reasonably good spike in the coming years. And as I mentioned, we have developed an interesting pipeline of, DMS, so we should see some sales coming from that sooner than later. And at the FDF level, as I already said, I think the JV looks pretty interesting, and even non-JV business, which is Indian business as well as the CIS business, probably needs to be a little bit of CapEx spend to be done in this year, but I'm sure, that also will wrap up substantially. And in specialty chemical business, I think we still remain focused after the divestment. We remain focused on our photochromic business, on hair dye business, as well as antimicrobial business. And recently, we have seen some interesting tie-ups with, major companies like Coty, Mitsui. So we are optimistic that all these initiatives which the company has been investing in the last couple of years should come into play in the coming years and the future years. And thank you very much for all your patience and support.